Picture this. June 1932. You're standing inside the marble lobby of Central Republic Bank of Chicago, and the line behind you stretches through the revolving doors and down LaSalle Street. The man next to you is a grain merchant from Evanston. He hasn't slept. His account holds $4,200, the savings from 11 years of licensed trade. He heard the whisper at breakfast. The bank is going under. He doesn't know whether it's true. Nobody does. That's the point. The marble floors are cool. The tellers are smiling. The vault door at the far end of the lobby is closed, as it always is. The building feels permanent. The institution feels permanent. But 14 days ago, a man named Charles Gates Dawes, Nobel laureate, former Vice President of the United States, RFC board member, quietly resigned from the federal emergency lending body he had helped design. He gave no public reason. He said he needed to return to his bank. That bank is this bank. The loan that will keep it standing was already being negotiated before he walked out the door. This isn't dystopian fiction. This was the documented operation of the Reconstruction Finance Corporation in the summer of 1932, an institution created by Congress, funded by taxpayers, and administered by the same individuals whose private banks it was simultaneously rescuing. The forensic record is specific. The Emergency Relief and Construction Act of August 1932 required the RFC to report its loan recipients to Congress. The Hoover administration sent those reports marked confidential. Speaker John Nance Garner forced publication via House resolution, and what the list revealed stopped congressional debate cold. One institution, Central Republic Bank of Chicago, had received $90 million. Its total deposits at the time were approximately $95 million. The institution was functionally insolvent. The loan was, by any forensic definition, a bailout of an insider. This pattern has a modern record. The Federal Reserve's emergency lending facilities between 2008 and 2010 disbursed approximately $16 trillion in total credit extensions, with recipient identities withheld from Congress until a 2011 audit mandated by Dodd-Frank. The Bank of Japan maintained documented preferential lending rates for institutions holding government bonds from 1999 through 2006. The European Central Bank's LTRO operations of December 2011 disbursed €489 billion to 523 banks, with no public disclosure of individual recipients for over 6 months. The information asymmetry is structural. Here's the thing that keeps me up at night. Every major financial emergency creates an emergency institution, and every emergency institution is built by the same people who will later need to use it. That is not an accident. That is how the mechanism functions. The question is never whether the rescue will happen. The question is who designed the door, who holds the key, and who is standing closest to it when the system starts to crack. The 1932 RFC is a story about proximity, about how institutional architecture determines who absorbs the loss and who absorbs the rescue. I went through the forensic record on the RFC, the Federal Reserve's 1932 open market operations, Charles Dawes' complete institutional history, and the documented disclosure fight between the Hoover administration and Congress. By the end of this video, you'll know exactly how the RFC's loan secrecy provision was designed and legally defended, how Dawes moved from Nobel Peace Prize winner to bailout recipient in 8 years, and why that arc is structurally coherent rather than incidental, and why the correspondent banking argument the RFC used in 1932 is the same argument that made every subsequent insider bailout unimpeachable on systemic grounds. Stick with me. Before we get into the individual cases, I want to name the mechanism this video examines, because it shows up in every major financial crisis, across every era, in every country with a functioning central bank. I call this the revolving door bailout sequence. The forensic record shows it operates in 4 consistent stages. Stage 1 is institutional capture. An emergency institution is created to manage a systemic crisis. Its leadership is drawn from the private financial sector because, the argument goes, only practitioners understand the system well enough to manage it. The people appointed are, by definition, people with existing relationships with the institutions they will be supervising and potentially rescuing. Stage 2 is information asymmetry. The emergency institution has access to the complete financial condition of every bank it examines. It knows which institutions are truly solvent, which are technically insolvent but politically important, and which are both. The general public, the press, and in many cases Congress, do not have access to this information. The institution controls the diagnostic. It also controls the remedy. Stage 3 is preferential allocation. When loans are dispersed, the institutions best positioned to receive them are the ones whose principals have the closest relationships with the lending body. This is not always corrupt in the legal sense. It is structurally determined. The institutions with the most sophisticated relationship networks are also the institutions whose failure would most threaten the people administering the rescue. The incentives align. The forensic record confirms the alignment. Stage 4 is disclosure suppression. The emergency institution resists public disclosure of recipient identities. The stated reason is always the same across every historical iteration. Disclosure will cause bank runs. This argument is not wrong, but it also serves another function. It prevents the public from assessing whether the allocation was made on systemic grounds or on preferential grounds. The secrecy protects the system. It also protects the decision-makers. This 4-stage sequence appears in 1932. It appears in 2008. It appears in 1998 during a long-term capital management rescue. It appears in 1980 during the Continental Illinois bailout. It appears in 1914 during the founding operations of the Federal Reserve itself. The mechanism is not a product of any individual's corruption. It is a product of structural design, and once you can name the 4 stages, you will see them in sequence every time an emergency institution appears. Number 1 is the most obvious, and yet it's the one most institutions repeat. The Dawes sequence, Nobel Prize to bailout in 8 years. To understand what happened in June 1932, you have to go back to April 1924. Charles Gates Dawes is 58 years old. He is standing in front of the Allied Reparations Commission in Paris, having just completed the plan that will carry his name for the next century. The Dawes Plan restructures Germany's World War I reparations payments. The logic is elegant. American banks will lend Germany approximately 800 million gold marks. Germany uses those loans to stabilize its currency and resume reparations payments to Britain and France. Britain and France use those reparations receipts to service their war debts to American banks. The cycle is circular. The architecture is deliberate. American capital flows out, reparations flow in, and the men who designed the flow, primarily New York banking houses led by J.P. Morgan partner Thomas Lamont, collect fees at every stage of the circuit. Dawes wins the Nobel Peace Prize in October 1925. He becomes Vice President of the United States under Calvin Coolidge in March 1925. He is, by every available measure, the most credentialed financial statesman in the Western world. Here's the brutal math. Between 1924 and 1930, American banks lent approximately $124 billion to German municipalities, corporations, and the German central government under the Dawes and Young Plan frameworks. By 1931, as the Great Depression deepened and Germany's export revenues collapsed, those loans began to fail. The Standstill Agreement of August 1931 froze $1 billion in short-term German debt held by international creditors. A significant portion of the American exposure to that freeze was held in Midwestern banks. Central Republic Bank of Chicago, where Dawes served as chairman after his vice presidency ended in 1929, held German bonds as part of its investment portfolio. Pattern confirmation. The revolving door bailout sequence requires Stage 1, institutional capture. Dawes's appointment is the documented example. The man most familiar with the mechanism of the crisis was placed in charge of administering the rescue. His familiarity was not only with the solution, it was with the problem he had helped design. Number 2 is where the pattern gets counterintuitive. The resignation that wasn't a resignation. On June 6, 1932, Charles Dawes submitted his resignation from the RFC Board of Directors. The stated reason was that his banking responsibilities in Chicago required his full attention. The resignation was accepted without controversy. The press recorded it briefly. Dawes returned to Central Republic Bank. 3 weeks later, on June 27, 1932, the RFC approved a loan of $90 million to Central Republic Bank of Chicago. The official story is that Dawes resigned to avoid a conflict of interest. He saw that his bank was in trouble. He removed himself from the institution that would decide its fate. He followed proper procedure. The forensic record tells a completely different story. Here's what the forensic record shows. The $90 million loan approved June 27th was equivalent to 94.7% of Central Republic Bank's total deposit base of approximately $95 million. An institution is not in temporary liquidity distress when it requires emergency funding equal to its entire deposit liability. It is insolvent. The loan was not bridging a short-term gap. It was replacing the bank's entire funding structure with federal money, while the bank's actual asset quality was concealed from the public depositors still standing in line on LaSalle Street. Dawes had been on the RFC board from January through June 1932. During those months, the RFC's examination teams had access to the complete balance sheet condition of every bank seeking, or likely to seek, emergency assistance, including the Chicago banking sector where Central Republic operated. Dawes would have known in full forensic detail the condition of his own institution. He would have known what the loan application would need to show. He resigned 21 days before the application was approved. The RFC's own internal files, portions of which are documented in Barry Eichengreen's Hall of Mirrors and Jesse Jones's memoir $50 Billion, show that the Central Republic loan was among the most controversial in the RFC's early history. Jesse Jones, a Texas Democrat who later ran the RFC under Roosevelt, described the Dawes loan as the decision that made the secrecy fight with Congress inevitable. If the public knew the largest single recipient was a bank run by a former RFC board member, Jones wrote, the political damage to the entire program would be catastrophic. Pattern confirmation, stage 3 of the revolving door bailout sequence. Preferential allocation does not require a smoking gun. It requires proximity, information access, and a 21-day gap between resignation and loan approval. The forensic record documents all three. Number 3 is the disclosure fight that established a template still in use today. Speaker Garner and the publication of the list. John Nance Garner of Texas was Speaker of the House of Representatives in 1932. He was a Democrat from Uvalde. He had no fondness for Wall Street, no fondness for the Hoover administration, and no fondness for federal programs that dispensed public money behind closed doors. When the Emergency Relief and Construction Act was passed in July 1932 and expanded the RFC's authority, Garner inserted a provision requiring the RFC to report its loan recipients to Congress. The Hoover administration interpreted this as a congressional filing, not a public disclosure. The reports were filed. They were marked confidential. Garner forced a House floor vote in August 1932. The resolution passed. The RFC's loan recipient list was published. Here's the brutal math on what happened next. Within 2 weeks of publication, RFC recipient banks in Texas experienced documented deposit withdrawals that several institutions characterized as accelerated runs. The Hoover administration pointed to this as proof that disclosure was dangerous. What they did not publicly state was that the withdrawals occurred because depositors, upon learning their bank had needed an emergency federal loan, rationally reassessed whether the institution was solvent. The disclosure did not create the insolvency. The disclosure revealed it. The RFC loan list published in August 1932 showed 4,600 institutions. The single largest recipient was Central Republic Bank of Chicago at $90 million. The second largest recipient was a railroad, the Baltimore and Ohio, at $22 million. The third was a group of agricultural credit corporations in the South. The concentration of the largest loan in a single institution, controlled by a recently resigned board member, was visible to anyone who read the list. Congress read the list. The press read the list. The public read the list. What followed was a congressional hearing in which RFC officials were asked to explain the Dawes loan. Their answer was that Central Republic Bank was a systemically important institution whose failure would have triggered cascading defaults through the Chicago correspondent banking network. That was documented and plausible. Chicago's banking system at that moment was interconnected in ways that made a single large institution's failure genuinely dangerous. The RFC's systemic argument was not wrong. But the systemic argument is also precisely the argument that makes the revolving door bailout sequence so durable. An insider bailout and a systemic rescue can be the same transaction. The mechanism allows both to be true simultaneously. And because the systemic justification is documentably valid, the insider dimension is never prosecutable. It is only visible in retrospect. Only visible when the list is published. Pattern confirmation, Stage 4, disclosure suppression, has a specific function beyond self-protection. It delays the moment at which the forensic record becomes readable. Every day the list remained confidential was a day during which the systemic justification could be developed and refined before the insider dimension became visible. Number 4 is the man nobody talks about when they tell this story. Eugene Meyer and the institution that regulated itself. Charles Dawes is the name that appears in the RFC disclosure controversy. He is the visible figure. He is the former Nobel laureate who resigned 21 days before his bank was rescued. But the more structurally important figure in the 1932 banking crisis is Eugene Meyer. Eugene Meyer was appointed governor of the Federal Reserve in September 1930. He was also appointed the first chairman of the Reconstruction Finance Corporation when it was created in January 1932. For approximately 6 weeks, one man simultaneously controlled both the Federal Reserve, the lender of last resort with access to unlimited government securities purchases, and the RFC, the emergency bailout fund with authority to make direct loans to failing institutions. He held both positions from January 22 through approximately February 28, 1932, when he resigned the RFC chairmanship. Here's the brutal math. Between January and August 1932, the Federal Reserve's Open Market Committee, operating under Meyer's governance, purchased approximately $11 billion in government securities in what was then the largest open market operation in the Fed's 18-year history. In the same period, the RFC under first Meyer and then Dawes dispersed $1.78 billion in direct loans. The two institutions were operating in parallel, both injecting liquidity into the same banking system, both administered by men drawn from the same private financial networks, and both operating without public disclosure of their specific allocations. The Federal Reserve's own internal communications, documented in Milton Friedman and Anna Schwartz's A Monetary History of the United States, show that Meyer pushed aggressively for the $1 billion open market purchase program over the documented objections of the Chicago Federal Reserve Bank. The Chicago Fed's president argued in writing that the purchases risked inflation. Meyer argued the deflationary spiral was the greater risk. Meyer was, by the consensus of economic historians, correct. But his correctness does not erase the structural reality. The man making the decision had personal financial interests in the sector. The decision was designed to rescue. Pattern confirmation. The revolving door bailout sequence does not require the rotating door to be visible. In the Meyer case, the door was the institution itself. The Fed and the RFC were not separate bodies with separate leadership that happened to coordinate. For 6 weeks in early 1932, they were effectively the same body under the same governor. The mechanism was not a revolving door. It was a single room with no door at all. Number 5 is where the systemic logic reveals itself most completely. The correspondent banking argument and who it protected. The RFC's defense of the Central Republic loan rested on a specific claim. That Central Republic Bank was the center of a correspondent banking network in the Chicago area, and that its failure would trigger sequential failures in dozens of smaller banks across Illinois. This argument was documented in RFC internal memos and later reproduced in congressional testimony. It was not fabricated. The correspondent banking structure was real. Here is what correspondent banking meant in 1932. A small bank in Peoria or Rockford held its reserves not in the Federal Reserve, but in a large city bank. In Chicago, Central Republic was one of the primary reserve holders for a network of approximately 60 smaller institutions across northern Illinois. When a small bank needed to meet a withdrawal demand, it drew on its correspondent account in Chicago. When Central Republic's own liquidity was impaired, those 60 institutions could not access their reserves. The chain ran downward. Central Republic fails. Correspondent banks cannot meet withdrawals. Correspondent banks fail. Their depositors lose savings. Here's the brutal math. The documented estimate from RFC files, reproduced in Jesse Jones's memoir, was that Central Republic's failure would have triggered exposure for approximately $300 million in correspondent deposits across the Illinois banking network. The $90 million loan was presented as cheaper than a sequential cascade that would have required the RFC to rescue dozens of smaller institutions individually. The per-dollar cost of stopping the chain at Central Republic was lower than letting the chain run. That arithmetic is verifiable. The systemic argument holds under forensic examination. But here is what the correspondent banking argument also accomplished. By framing the Central Republic rescue as a systemic intervention rather than an institutional bailout, the RFC insulated itself from the insider dimension of the Dawes resignation. The question was no longer whether the largest loan recipient had been managed by a former RFC board member. The question became whether the entire Illinois banking chain was worth $90 million. It was. The chain argument was unanswerable. And it remains unanswerable in every subsequent iteration of this mechanism. The too big to fail argument is the specific rhetorical technology that makes the revolving door bailout sequence permanent. Because the systemic risk is real. Because the chain effect is real. Because the cost of letting a correspondent network collapse is genuinely, documentably higher than the cost of the rescue. The argument is correct, and it is also the argument that makes every insider bailout unimpeachable. If the institution is large enough to threaten the system, it will be rescued regardless of who is standing closest to the door. Pattern confirmation, the correspondent banking argument of 1932, is the direct predecessor of the too big to fail arguments made in September 2008 regarding Bear Stearns, Lehman Brothers, and AIG. The institutional language is different. The mechanism is identical. Number 6 is the outcome the official history omits. The $90 million that did not save the bank. The Central Republic loan was approved June 27, 1932. It was dispersed. It was publicly defended. Charles Dawes became the face of what critics called the most egregious example of insider access in the RFC's history. He disputed this characterization publicly and in testimony. Here's what the forensic record shows about the outcome. The $90 million loan did not save Central Republic Bank of Chicago. By the end of 1932, the bank was reorganized under a new entity called the City National Bank and Trust Company. Its shareholders were wiped out. Its original depositors recovered a portion of their funds through the reorganization, but the institution, as a going concern, ceased to exist in its original form. The RFC ultimately recovered most of the $90 million through the reorganization process, but the timeline stretched into the late 1930s. Charles Dawes testified before Congress in 1933. He stated that the loan had been necessary to prevent systemic collapse. He stated that he had resigned before the loan was approved. He stated that his resignation had been a proper procedural response to the conflict of interest. He was not prosecuted. No RFC official was prosecuted in connection with the 1932 loan program. Here is the number that crystallizes the outcome. Between January 1932 and March 1933, the RFC disbursed approximately $2.3 billion in emergency loans to financial institutions. Total bank failures during the same period numbered approximately 3,000 institutions. The two numbers coexisted. Two numbers, $2,500 and ballers. The $3,000 dispersed. 3,000 banks failed. The bailout fund operated in parallel with the collapse it was designed to stop. Not because the fund was fraudulent, because the scale of the collapse exceeded the design capacity of any institutional response. The RFC was not large enough to stop the cascade. It was large enough to determine who survived the cascade, and that determination, who gets the loan, in what amount, approved by whom, was made inside the information asymmetry that the secrecy provision maintained for as long as it could be legally defended. Pattern confirmation. The revolving door bailout sequence does not guarantee survival for the rescued institution. It guarantees that the rescued institution receives preferential access to the available resources. Central Republic failed anyway, but it failed on a slower timeline, with a managed reorganization rather than a depositor run. The insiders who designed the mechanism ensured their institution had access to the process. The process, in this case, was not sufficient to prevent failure. It was sufficient to prevent the disorderly failure that would have publicly destroyed the institution's principles. Same mechanism, same sequence, same outcome. An emergency institution is created. It is staffed by practitioners. Information asymmetry is constructed and defended. Loans are dispersed on a combination of systemic and preferential grounds, simultaneously in a way that makes the two indistinguishable. Disclosure is delayed until the systemic justification can be fully developed. The institution that needed the rescue survives in some form. The officials who administered the rescue are not prosecuted. The depositors and small savers who trusted the system absorb whatever residual loss the rescue did not cover. The Federal Reserve's emergency facilities between September 2008 and March 2009 disbursed approximately $7 trillion in peak commitments, confirmed by the 2011 Bloomberg audit mandated by Dodd-Frank. The identities of recipient institutions were withheld from Congress for over 2 years. The Bank Term Funding Program, created in March 2023 following the failure of Silicon Valley Bank, was authorized at up to $25 billion and ultimately utilized for approximately $165 billion in peak outstanding loans. The names of institutions whose deposits at SVB and Signature Bank were protected above the $250,000 FDIC limit included firms with documented relationships to Treasury and Federal Reserve officials. The information asymmetry was identical. The timeline of disclosure was shorter. The mechanism was the same. The sequence Charles Dawes navigated in 1932 is not a historical curiosity. It is the documented operating logic of every emergency financial institution ever created. The architecture determines the outcome before a single loan application is filed. Drop in comments if you've ever wondered who actually decides which institutions get rescued when the system breaks. I read every single one. Subscribe to The Money Architect. This channel examines how money, power, and systems have interacted across history. The documented evidence, the real outcomes, so you can read the situation before it reaches you.